Okay, so you want to own an AI data center, a warehouse full of humming machines, quietly printing money, while the entire world races to build artificial intelligence. You lease out compute power to the companies training the next generation of AI, and the checks just keep arriving. That's the picture. That's the pitch every infrastructure fund is making right now. And it's not entirely a lie. Here's what that pitch doesn't show you: a single facility that can cost more to build than most professional sports franchises. A piece of equipment inside it that might be technologically obsolete before you finished paying off the loan you took out to buy it. And a company that just lost $67 billion in market value in a single day, in part because investors suddenly started asking hard questions about exactly this kind of spending. By the end of this, you'll understand exactly why AI data centers cost 3 to 4 times what a normal data center costs, why the biggest risk in this business isn't the building, it's what's inside it, and why some of the smartest investors on Wall Street are starting to use the word bubble. Before we get into the numbers, you need to understand what an AI data center actually is, because it is not the same business as a normal data center, even though they look identical from the outside. A traditional data center is built to store and serve information, websites, email, company records, work that doesn't generate much heat and doesn't need much power per square foot. An AI data center exists to run enormous banks of specialized processors, the chips that train and operate artificial intelligence models, and those chips are power hungry and heat generating in a way that changes almost every part of the building's design. You need denser electrical systems, industrial grade liquid cooling instead of simple air conditioning, and enough power capacity to rival a small city. That difference alone is why AI data centers cost dramatically more to build than the facilities that came before them. Let's talk about the number that gets all the attention first: the construction cost. A standard data center in 2026 costs roughly $11 million per megawatt of capacity to build, a number that's been climbing steadily for years. An AI-optimized facility, the kind built specifically to house rows of high-density processors, runs $30 to $40 million per megawatt once you include the specialized cooling and power infrastructure. That's 3 to 4 times the cost for the same physical footprint. A modern hyperscale campus, the kind the largest tech companies are building right now, gets discussed in gigawatt terms, and fully built-out AI infrastructure at that scale can run $45 to $55 billion per gigawatt. One of the largest technology companies in the world recently committed $27 billion to a single data center facility. One building, $27 billion. But the construction cost is really just your ticket to the game. It's the down payment on a business with one of the strangest risk profiles in modern infrastructure. There's a saying that's starting to circulate among people who actually build these facilities, and it captures the core problem better than any spreadsheet could. You're building a building meant to last 30 years around a chip that might be obsolete in 3. Here's where that risk actually comes from. A data center building itself, the concrete, the power systems, the cooling infrastructure, is a genuinely long-lived asset, the kind that can operate productively for 2 or 3 decades. The processors inside it are a completely different story. AI chip technology is advancing so quickly that a facility built around today's most advanced processors can find its hardware meaningfully outdated within just a few years, as newer, faster, more efficient chips arrive, and the companies leasing your compute simply move to the newer generation. Unlike the building, hardware upgrades aren't optional. If your facility is running yesterday's chips, AI companies that need cutting-edge performance for training their most advanced models will lease space somewhere else. And here's the fact that stops most first-time investors cold. The actual computing hardware, the processors and specialized chips, frequently costs more than the building constructed to house them, sometimes several times more, once you account for a fully populated facility. You're not primarily investing in real estate with a technology component. You're investing in rapidly depreciating technology that happens to need a very expensive building wrapped around it. Then there's the part that catches almost every new investor off guard: power procurement. A large AI data center needs so much electricity that securing it has become the single biggest bottleneck in the entire industry. Transformer lead times, the wait to get the specialized electrical equipment needed to bring power into a new facility, now exceed 160 weeks. That's over 3 years just waiting for a piece of equipment before your building can even turn on. In some markets, regulators are now requiring new data centers to build their own on-site power generation or battery storage just to get approved, adding hundreds of millions of dollars in costs that have nothing to do with the actual computers you're trying to run. Add it up. Construction costs 3 to 4 times a normal facility, hardware costs that can exceed the building itself, power infrastructure with multi-year waiting lists, and cooling systems built to handle heat loads a traditional data center was never designed for. And a single AI-optimized data center at meaningful scale can require well over $1 billion in total investment before it generates a single dollar of revenue. Here's the part that separates this from almost every other asset we've covered on this channel. Unlike a diamond mine, this business has genuine, currently massive demand behind it. The 4 largest technology companies alone are expected to spend roughly $725 billion combined on AI infrastructure this year. NVIDIA's chief executive has projected that total AI infrastructure spending could reach $3 to $4 trillion by the end of the decade, an amount that would exceed the entire global semiconductor industry's annual revenue several times over. Every major cloud provider has publicly stated that demand for AI computing power currently exceeds what they can supply. This isn't speculative spending on unproven technology sitting empty. It's spending chasing demand that, at least for now, is real. The revenue model works through leasing compute capacity, typically under long-term contracts, to the AI companies and enterprises that need processing power for training and running their models. A well-positioned facility with modern hardware can command strong, stable lease rates because the companies renting that capacity would rather pay a premium for guaranteed access than build their own facility and wait 3 years for a transformer. If you want proof of how quickly sentiment can shift around this business, look at what happened to one major technology company this year. Its stock price fell 25% in a single trading session, wiping out roughly $67 billion in market value after its chief executive acknowledged the company had been too slow to adapt to how customers were shifting their spending toward AI infrastructure investments. That's not a company that ran out of demand. That's a company that got the timing and positioning of an AI infrastructure bet wrong, and the market punished it instantly and brutally. Which brings us to the real question sitting underneath all of this. If demand is genuinely this strong, where does the actual profit go, and who's carrying the real risk? The hardware manufacturers get paid up front, regardless of how the finished facility eventually performs. The construction and power infrastructure firms get paid on contract, whether or not the AI boom continues at its current pace. The companies leasing compute capacity commit to contracts that can often be adjusted or exited as their own needs evolve. The data center owner is the one holding a rapidly depreciating asset, financed with debt, in a market where analysts at major banks are projecting somewhere between $250 and $300 billion in new debt issuance from data center developers this year alone. Debt that has to be serviced whether or not the facility's hardware remains competitive. Let's build the 2 honest scenarios, because this is where the real picture comes into focus. In the good year, you've built a modern AI-optimized facility, secured a long-term lease with a major AI company at strong rates, and your power infrastructure came online on schedule. Demand for compute keeps climbing, your facility runs near full capacity, and the lease revenue comfortably covers your debt service while your hardware remains competitive for the length of the contract. The facility behaves almost like a toll road, collecting steady payments from a technology that shows no signs of slowing down. And then, over the following several years, everything changes. In the bad year, a newer generation of chips arrives faster than expected, and your facility's hardware, only a few years old, becomes meaningfully less attractive to the AI companies training frontier models. Your anchor tenant doesn't renew, choosing a newer facility instead. You're left with a building perfectly capable of running for another 2 decades, filled with equipment that's rapidly losing its value, and a debt payment that doesn't care which generation of chip is fashionable this year. Meanwhile, if the broader AI bubble narrative gains traction, and enough facilities like yours come online at once chasing the same demand, lease rates across the industry can soften just as your own hardware is aging out, squeezing you from both directions simultaneously. That gap, the difference between a facility with a fresh, in-demand hardware generation and one that's fallen even slightly behind, is the entire story of AI data center ownership condensed into one problem. And unlike almost every other asset we've covered on this channel, the building itself was never really the risk. The technology cycle inside it is. So here's the honest question. If the demand is real and the money being spent is real, why are serious people using the word bubble to describe this industry? The answer is that a bubble doesn't require the underlying demand to be fake. It only requires the capital being deployed to outrun the ability of that demand to generate returns fast enough to justify it. And right now, Hundreds of billions of dollars are being committed on the bet that AI compute demand will keep climbing exactly as fast as the facilities being built to serve it. People think they're buying real estate with a technology upgrade. The smartest investors in this space know they're actually buying a bet on the pace of technological change itself, wrapped in a building that just happens to look like infrastructure. Which is exactly why, in this business more than almost any other on this channel, the ones who get the timing wrong don't lose slowly. They lose the way that company lost $67 billion, all at once.